4,421 last night. How many of you stared at that 10-day gold average and couldn't sleep? You watched months of gains in your account wiped out in a few hours. Watched gold, that supposed safe haven, drop like a kite with a cut string. Even at home, prices broke the psychological 993 RMB gram mark. Are your fingers hovering over the sell button right now, trembling? Are you thinking, that's it, the top's out, bull market's over, better cut losses? Stop. If you press that button now, if you hand over your chips now, congrats, you've just fallen perfectly into a century-old plot set by top Wall Street predators. You'd be making a strategic mistake you'll regret for a decade. This morning, every financial outlet and analyst kept repeating the same scapegoat. Bloomberg Commodity Index annual rebalance expects about $14.1 billion of gold and silver selling. Silver $7.1 billion, gold $7 billion. Sounds professional, sounds logical. Precious metals did great last year. Weights got too big, so passive funds must sell. That's just the rule. I can only laugh. That kind of explanation treats global investors like single-celled organisms who only read headlines. Use your common sense. Was Bloomberg's annual adjustment decided yesterday as a surprise? No, it was a known move. It's a revealed card. That rule was on the calendar, public a half month or more in advance. Do you really think Bridgewater, BlackRock, Millennium, the funds running hundreds of billions, would be dumb enough to wait until January 8th and suddenly think, oh snap, rebalance now, sell? Impossible. At the top of the food chain, real killer news is the unexpected black swan. A public, known negative, only has one use in the trader's playbook, to help cut someone else's throat. So $14.1 billion against a market that trades trillions daily, what is that? Even if dumped, it's a ripple on the lake. Why did prices crash so violently last night? Because it was a coordinated operation. Wall Street vultures, no retail traders. They panic. A little noise and retail tramples itself. So they use the $14.1 billion as a smokescreen. At that moment, amplified by media hype, they deployed short money to kick the market at key technical levels. That's leverage. That's finesse. They blare we're selling on screens to create a crushing atmosphere. Why? To scare you into selling. It's a targeted demolition. Inflate the Bloomberg rebalance paper tiger to hide their real plan. Real hunters don't follow words. They watch actions. Look at last night's volume. That long down candle came with big volume. More volume means a lot of people were selling, but also a lot were buying. If this were a genuine consensus-driven collapse, it would be a low-volume freefall. Nobody dares to take the other side. But last night, every panic sell from retail was swallowed in milliseconds by an invisible giant buyer. Who had the guts to bite against that known negative? Who had pockets deep enough to catch that avalanche? Here's the hidden, decisive signal most missed, the nuclear level indicator that can shape wealth distribution for the next decade. While Wall Street used Bloomberg to smash the market, on the other side of the planet, a mysterious Eastern force played a 1.1 trillion yuan trump card. Yesterday, China's central bank did something seismic. That's the real ace behind the crash. Before we dive into that Eastern move, let's dissect Wall Street's other whip, the CME. Last night's crash wasn't only sellers. Half of it was forced selling among retail. What's a reverse liquidity trap? How did they pull your ladder away and leave you no escape? If Bloomberg's $14.1 billion was the bait, the paper tiger to scare the flock, then the CME's whip was the actual blade that caused bleeding. Many retail traders watched the screen as gold sliced support and wondered, even if Bloomberg sells, it shouldn't fall this cleanly. Shouldn't longs fight back? They didn't because longs were disarmed. At least half the drop wasn't someone choosing to sell. It was countless hopeful bulls being forced to sell themselves. Focus on this invisible, deadly move. CME raised margin requirements for precious metals. Plainly, they yanked the ladder while you were halfway up. In futures, everyone uses leverage. $1 of capital moves $10 or $20 of gold. CME, like the house, lets you borrow. But last night, CME coldly said, volatility is too high, top up your account or we'll liquidate you. Worse, this was the third margin hike in a month. A chained killing. First margin call, you might have spare funds and top up. Second, you grit your teeth and add more. The third hit, when Bloomberg's public negative, was amplifying losses. Your floating losses are bigger. And CME now demands even more. Most retail have run out of bullets. No cash equals forced liquidation. The system sells your longs at market price, no regard to cost. That creates a massive, mechanical, emotionless sell wave. That triggers a vicious negative feedback loop. Price down gives margin calls, gives forced selling, gives price down further, gives more liquidations. That glaring deep V last night, it's stacked with retail's bloody chips. Top Wall Street hunters didn't even have to swing a hammer themselves. They used the rules in CME's whip to watch leveraged traders self-destruct. In trading speak, longs not dying, downtrend won't stop. They need to clear your leverage before they step in. But the cruelest part isn't mechanical, it's psychological. The reverse liquidity trap. Textbook liquidity traps mean lots of money but no one invests. Wall Street tailored the opposite. They manufactured a buy-side vacuum so you'd feel there's no bottom. Remember that panic moment when prices pierced 44,504,440 down to 4,421? You might have thought it was oversold. But when you opened the order book, buy 1, buy 2, buy 3 were empty. The usual dense buy orders had been pulled. The market felt like a black hole. You throw chips in and hear nothing. That's artful manipulation. Using Bloomberg's sell narrative plus CME's margin squeeze. They painted a picture. Gold's worthless. It'll go to 4,000. Under that pressure, your fear beats reason. You post market sales just to escape the hole. Exactly what they want. Below that inferno, under the black, there was already a thick soft cushion. Wall Street yells fire. CME pulls your ladder, forcing you to jump. You think you'll crash, but there's a cushion catching most of the fall. Who picks up those fallen chips? The same people who screamed panic up top but quietly had iceberg orders at the bottom. That's visible selling with hidden buying. A sophisticated buy-the-dip strategy. You need a liquidity black hole to buy cheaply. This time, the cushion wasn't only Wall Street, a far larger, steadier force didn't care about Kaling's or CME moods. It had infinite ammo and, last night, used 1.1 trillion yuan to complete a flawless strategic swap. Who is that force? Why act now? Not just to profit, but to gain pricing power. We'll expose that ace. Move your eyes from New York trading floors back to Beijing's central bank. See how this 1.1 trillion yuan buyout-style reverse repo at a crucial moment turned into a silver bullet against Wall Street shorts. The gold market now isn't just about price swings. It's a contest of who understands global rules deeper. Since Wall Street can weaponize rules, our core need in extreme moves is reading traps and not being washed out by flash spikes. I put together a gold bull shift rulebook that maps these flash crash signals in game scenarios to help you lift your gaze from candles and see the playbook. It's in the comments. While Wall Street was proud of making a liquidity black hole and thought they'd wash out retail, they didn't expect a giant net lying quietly on the other side of the globe. If Wall Street's move was tactical, the Eastern response was strategic crushing. Look beyond the flickering charts to the real notice that decided gold's fate yesterday. As the flash crash occurred, China's central bank did something earth-shaking. It launched a 1.1 trillion yuan 3-month buyout-style reverse repo, plus 28.6 billion yuan of 7-day reverse repos. Many skim past the words reverse repo, thinking it's boring interbank stuff. Dangerous mistake. In a financial fight, this is frontline heavy artillery. Do the math that makes Wall Street shorts despair. Bloomberg's rebalanced sell is $14.1 billion. China's 1.1 trillion yuan equals about $150 billion. 150B versus $14.1 billion. 10 times the firepower. It's like someone pulls a knife and you bring a Gatling gun. This huge liquidity isn't just holiday red envelopes. Under free-flowing capital, liquidity flows to value pockets. When Wall Street pushes gold down to that value hole at 4,421, this 1.1 trillion yuan trickles through hidden channels and becomes super buying power for gold. You get an aerial refuel, Western capital guns for low prices. Eastern capital pours liquidity and picks up the stock. This isn't a crash, it's textbook misdirection. Wall Street shouts fire to force retail to sell, while an eastern state set up the biggest cushion downstairs. Your panicked chips fell into their net and were scooped. When the smoke clears, you'll see, gold didn't collapse, massive buying propped it. The losers are emotional retail who sold, winners are strategic holders who bought low. Chips move from fickle speculators to buy and hold strategic owners, a perfect strategic swap. Don't believe in conspiracies. Data's cold. China's central bank has been increasing gold reserves for 14 straight months now, 2,306 tons, and foreign exchange reserves are near a decade high. What does that prove? The central bank buying isn't for quick trading gains. A central bank is the last guardian of national financial security. They've got far more info and top brains. If gold were peaking, if the dollar were going to strengthen, why would central banks, especially Eastern ones, hoard gold at these high levels, almost urgently? There's only one explanation. Central banks aren't trading, they're preparing. They're stocking hard currency for a bigger storm. In their strategic game, today's 4,470 isn't a top, it could be a base. They're seeing storms retail staring at minute charts, can't imagine. This ambush's ultimate aim isn't profit, but pricing power. For 80 years, gold pricing sat in London and New York. Wall Street could use paper gold to manipulate prices and harvest the globe. Now it's changing. Eastern powers are taking real positions under Western selling. Shanghai's volumes are catching up to New York. Pricing power is shifting east. This 1.1 trillion yuan ambush says, try to smash it, I'll buy whatever you throw at me. Once chips are locked in deep vaults, they won't return to the market. Circulating supply shrinks, shorting becomes costlier, and the bottom gets welded shut by this huge liquidity. So last night's drop wasn't a bull market end, it was a stall and a gear change. Wall Street tried to shake you off to keep the future gains to themselves. But the Eastern ambush shows this ride won't stop. It will swap to a stronger engine and climb to the next peak. Behind this bull is not just central bank buying. There's a grander backdrop. Last night there was another headline few noticed, one that could mark the end of an 80-year era. It's small, but heavy. Global official gold reserves valued at $3.9 trillion have officially surpassed overseas holdings of U.S. Treasuries at $3.8 trillion. Remember those two numbers, $3.9 trillion versus $3.8 trillion. This isn't a small stat tweak, it's a qualitative shift. For nearly 30 years since the 1990s, gold has never outvalued U.S. Treasuries as a reserve asset. That just changed. What does it mean? Since Bretton Woods in 1944, the dollar was the anchor. Nations converted foreign earnings into treasuries, recycling back to the U.S. to fuel consumption and power. Treasuries were the global system's bedrock. Last night that bedrock cracked. When central banks prefer non-interest-bearing, custody gold over liquid treasuries, something shifted. Principal safety now outweighs interest yield. It's a collective global wager. I don't trust your dollar. I trust my gold. Why the reversal? Not because gold rose crazily. Because U.S. debt credibility collapsed. What did the U.S. do? It weaponized the dollar, cutting SWIFT access, freezing sovereign FX reserves on a whim. Billions in Russian reserves vanished. That slap opened the eyes of many countries. They realized dollars in U.S. systems aren't truly theirs. They're conditional IOUs. If the U.S. chooses, the IOU can be rendered worthless. Who'd park their wealth in treasuries after that? Even staunch allies like Germany are moving gold back to Frankfurt. So gold overtaking treasuries is more than price. It's sovereignty awakening. Gold has no issuer, no counterparty risk. In this swing from credit currency to hard asset, treasuries recede and gold rises. This logic is reinforced by another grim macro reality. U.S. debt. Federal debt has passed $38 trillion, about 130% of GDP. Interest alone is crushing the budget. America looks like a sick giant kept alive by printing. Fed officials may talk resilience, but it's self-delusion. As long as three facts persist, the gold bull case is rock solid. Debt growing exponentially. Central banks reducing treasury holdings. The U.S. using force to preserve hegemony. The U.S. can't realistically fix the debt. Options. Print to dilute debt or resort to conflicts and default by proxy. Either path leads to currency revaluation and gold revaluation. So now, viewing Bloomberg's $14.1 billion sell as a grain of sand in a currency system overhaul is accurate. If you sell your gold over a 1% dip, you're not just exiting an asset, you're throwing away a ticket to a new world. You're jumping off the lifeboat and swimming back to the sinking Titanic of dollar hegemony. Wake up! Central banks scrambling with 1 yuan. 1T to grab that ticket. What right do you have to get off? Gold has become a national chip and an individual last line of defense. So what should ordinary people do in this chaos? How do we hold the line during Wall Street's tantrums? Don't go anywhere. I'll give my chief orders at the end of the video. Why now is the last window to get back on, and how to set up buyout-style positions like a central bank. For ordinary folks without billions, what can we do besides watch Wall Street crush accounts? No. If you can see the cards, this becomes a chance for class mobility. I'll give 3 survival, even fattening, practical tips, hard-hitting, and vital. Most important, quit momentum gambling. Learn to be greedy when others are fearful. Last night, because of Bloomberg's rebalance, everyone was selling. CME was forcing liquidations. Fear was everywhere. Remember the iron law? All loudly broadcasted bad news is what the big players want you to see. All quiet good news is what they're quietly doing. On survival, ditch high leverage. Embrace real assets. Don't hunt quick riches with 50x leverage. CME upped margins 3 times in a month. That shows the washout isn't over. In this deep water game, both sides will get nastier. If you play like a gambler with huge leverage, you're prime meat on the CME chopping board. There are countless ways the big players can pin you and blow your positions before lifting. On conviction, fix your eyes on dollar credit. Ignore the noise. This year will bring noise, hawkish Fed talk, volatile jobs data, real and fake geopolitical flashes. If you chase every beep, you'll be driven mad by washouts. Finally, to everyone following me, 4,470 isn't a top, it might be a rest stop halfway up. The $14.1 billion sell was the opening act. The 1.1 trillion yuan ambush was the main event. This is a cognition war and a national strategy war. In a world full of lies, don't listen to what they say, watch what they do. This pullback is fate's last signal. Are you going to sink with the old dollar world or jump on gold's lifeboat? Hold your chips, stay put, no matter the storm. Don't get off. If we see their cards, Wall Street's scythe can't harvest us, it'll break instead. Let's take back our wealth. Wall Street used index tweaks and margin thresholds to clear longs, while Eastern central banks used 1.1 trillion yuan of massive liquidity to successfully reclaim chips at the bottom. With global official gold reserves now surpassing treasuries, the long-term logic of physical assets hedging credit currencies is irreversible. To help you respond calmly to such extreme game scenarios, I compiled a gold bull shift rulebook that systematizes the underlying rules and countermeasures. It's in the comments, click to get it.